Hi, and welcome back to Pay Down Debt Solutions, where today we're going to be talking about a workshop that we're going to be doing for our students. So we've decided that we're going to do a workshop. I told you guys about that in the last video. It is going to be July 20th. It is going to be at 7 p.m. We are keeping it to a small group, and what you're going to do is you are going to work your own worksheets under our tutelage. So it allows you guys for half the price of a coaching call. Okay, so for a coaching call, it's half the price, and it allows you guys to learn more about your own finances and how to run a velocity banking schedule on yourself, right? How to build it. We're going to show you how to do all that. And what's great about this is you guys get to learn not only from, us helping you, but you guys watching other plans being worked with too. So it gives you guys an option to really learn and get in depth with velocity banking and with these coaching plans. Now, it's a win-win situation because I'll tell you what, at the end of this, if you still feel like you can't quite grasp it, then we will go ahead and do a coaching plan for you minus what you've already paid for the workshop. So you guys, it's a win-win. What we want to do is bring to you guys that freedom and give you the confidence to be able to build your own plan if you all feel stuck. So if you would all feel stuck, this is a great way to do it. Otherwise, you guys just keep watching and learning how to run velocity banking because we know you can do it on your own, okay? The other thing I want to bring up is this. We had an amazing coaching student of ours who is giving you guys a free coaching session. So she felt, the need to pay it forward, and, we are so appreciative of that. So whether you are currently enrolled in a plan with us or not, at the end of the month, this month, okay, so June, we will be giving that away, all right? So if you haven't decided on coaching and you are on the fence, this is a great reason maybe to step in, right? Knowing that you could, get yourself a free coaching session, and we'll do a drawing for that. So you guys will be able to take advantage of that, and we'll keep it anonymous. So if you have a handle, we'll maybe use that, but I will draw it and then we'll try to keep it anonymous for you. All right, so today I want to get into, you are one small change away from being debt-free. One small change, okay? So we talk about all the time how to run velocity banking strategies, how to get yourself out of debt. And if you're finding that you're in debt, it is because you are running traditional banking structure. You are running in that system, you are running there, and you are running into more debt as opposed to running yourself out of it. And we are going to teach you that today, all right? So what do I mean by you are one small change away from debt freedom? Well, right now you're in the traditional banking structure, okay? And the traditional banking structure leaves you in a checking and a savings account, all right? So if you're in a checking and savings account and you're paying all your bills out of your checking account, like most people do, like Dan and I were doing at one point, and you end up paying all of your bills here, right? Your living expenses. So if you have gas, you're paying gas. If you have groceries, you're paying groceries out of your checking. Your utilities and your allowance, maybe your fund money for the month, okay? So all of that is being paid through the traditional banking structure, and it's coming out of a checking account. And if you're lucky enough to have 88 bucks left over in cash flow, you might then throw that in savings, only to find that you're pulling it out in a couple weeks because you have something else that happened where you need that money, right? You guys all know. I know it. You know it. I've been there. You're in it right now. So this is probably not working out so great for you. But you know what? This is how you've always done things. You've done things this way your entire life. So it makes sense, and you continue on doing what is crazy, right? The definition of insanity, doing the same thing over and over again and expecting a different result. Well, guess what? Change. Make one change. And that's the change we're going to talk about today. See, people are creatures of habit, right? You are all in this, habituation, right? Habituation. You're doing the same thing over and over and over again. So I'm asking that you guys dishabituate or unstick yourself, and unstick yourself in learn a different way. We're going to learn how to use lines of credit to get ourselves out of debt. And we are doing it through credit cards. That is all I'm going to focus on today, are credit cards, because that is the devil, right? That is the devil that everybody finds themselves involved with, are these credit cards that are, out of control, and they don't know how to pay them down because every time they make a payment, they seem to get nowhere, all right? And yes, a lot of you guys have loans out there too, just like this student scenario here. Very basic, very simple. It was a very simple case to work with, but I want to show it to you because I know that a lot of you are sitting in exactly this, okay? Very simple, but still feel stuck. And so it's that stuck that we want to take care of for you today. Okay, so here's something that I thought was very relevant, okay? So when you look at life in general, okay, so let's look at life. You know that change equals growth. People will say it all the time that in order to make changes, you got to grow, and in order to grow, you have to change, okay? So if change equals growth, okay, and growth then, when you grow as a person or when you grow in your finances, let's say, then options open up to you, don't they, okay? So when you were younger, right, and you started to grow up, there were many things, many doors that opened for you that weren't available to you when you were younger, right? Because you didn't either know as much, you weren't old enough to do it, so on and so forth, right? So when you're younger and you're growing up, options become available. Well, the same thing happens with your finances too, okay? And when you have options, right? So options are the same thing as choices. You have more options, there are more choices you can make. It's just which choice are you going to make? That then becomes the question. You have choices now, or you have options now. So what choice are you going to make with those options? Which one are you going to pick? All right. And when you have choices, that is when you become debt free. Okay. Because the power to change, all right, the power to make a different choice is what leads you to getting out of this traditional banking structure. But you also need to know how to do that. So you know what? We're going to skip all of this part here, and we're going to go straight from change to debt free, because that's what we're going to show you guys how to do today. All right. So let's take this. And by the way, I will take this case here. All right. And we're going to then work it, including the loan. Okay. So we have the SoFi loan, and then I'm going to take out and run a strategy for you to show what you would do if you just had a credit card. You're maxed out on everything, right? You have very little left to, as cash flow at the end of the month, and you only had a credit card. I'm going to take that and I'm going to run both scenarios for you so you can see different ways to look at things, okay? So if you're stuck in this traditional banking structure, and which most of you are, right? You're running all of your finances through the checking account, and you're hoping to have something to save at the end of the day. And we know, based on this student scenario here, that our debt payments equal $2,095, okay? So if I were to take my rent in my car at $1,155, and my car at $489, okay? And then I add in my debt payments, which are right here, okay? And I add in my debt payments, then what I end up with is $2,095, okay? Which means that my living expenses are $1,065. So these are my living expenses. So that being said, we know that right now you guys are paying for all of your debt payments out of this checking account, right? So it's all coming out of the checking, and your living expenses also are all coming out of the checking, all right? So you're making these payments and you have $88 in cash flow at the end of the month. And probably not even that, because life happens and things come up and you have to pay for things, right? So what if we know we have this credit card here, right? Just as I'm showing here, we have this Citi card, and we know that the Citi card has a balance of $13,196. And in this scenario, or in this case, right, this card, its limit, all right, so the card's limit is $13,000. So they're actually over limit on this card, okay? So guess what? They're paying over limit fees, right? So they're paying these extra fees. And so they have this SoFi loan here, they have this Citi card. What if we did something a little different, rather than this traditional banking structure where you're putting all of your income into that checking account, and then from that checking account, you're paying all your bills? What if we did something a little different? What if instead we took our gas and we put it on our credit card, and then we took our groceries and we put it on our credit card, and we took our utilities, and I don't know what's going on with my marker, but it's not doing so well here. And we took our utilities and we put it on our credit card. And then let's say we took our allowance here. Oh, there we go. And we put it on our credit card. So let's put all of this stuff we're going to be spending anyway out of our checking account, right? Because we spend, if our debt payments, right? So all these here, okay, the debt payments, if we put all of this from our checking account and we pay for all of this out of the checking, if we made one change, one simple change, and we put our gas, our groceries, our utilities, and our allowance, the fun things we want to do, if we put it all on this credit card, how would that change our life? How would it? Wait a minute, Jen. I can't do that because I'm maxed, right? My card is maxed. I'm over limit. I have, 196 on this card. I'm over limit. How in the world am I going to put things on my card? Well, this is how you're going to do it, right? So we know that our income is $32.48, okay? And right now, this income, what's available to me is we take our $32.48. Now remember, there are certain things we can't charge on the card, and I'm going to get to my point in just a second on how we can do this. Remember, there are certain things we cannot charge on a card, and those are all of these things here, right? Rent, car, city, and our loans. So you can't charge loans. You can't charge credit cards, okay? So those can't be charged. There are certain other bills you can't charge, but for the most part, everything else in life is chargeable, okay? For the most part. So what we know is, if this is the case, and we have to look at what we can't charge and what we can charge, right? So we have available income. So that's income that is available for us to use to put against this card, right? To make a payment to that card. And then we have what we have called chargeable expenses, okay? Which are what? Living expenses. So all of our living expenses at this point are chargeable expenses. And what are the living expenses? Our gas, our groceries, our utilities, our allowance, and our fund money. Those are all living expenses, okay? Now, if I take and look at my available income, well, what's available? I have the income that I get monthly, or the student gets monthly, is $32.48, all right? And she takes her $32.48 and she subtracts the $155 for rent, the $489 for her car, and the $181 for the SoFi loan that she has to pay, okay? And I'm gonna run that for you, but I want you to see something here. So this is what's available to us. Now, you'll notice that I don't have the $270 for the city payment on here, do I? Okay, that is not part of my available income at this point, all right? That I have to subtract, I should say. So it is not subtracted, I should say it's not subtracted from my available income. So I'm using this $270, okay? Now we know our chargeable expenses. We have our expenses here, our total expenses of $31.60. So here's $31.60 minus the rent, then the car, then we've got SoFi, and then we've got our city. Okay, so these are our chargeable expenses are $1,065, right? Our living expenses, chargeable expenses, living expenses in this case, right? So what I've done here is I've taken my total expenses and I've subtracted off everything that is non-chargeable, all right? So our chargeable expenses are the total expenses minus what is non-chargeable, okay? Which leaves us with chargeable expenses, which is all of our living expenses, right? That's what it equals. So I have this $270 that is still in my income. And I have it in my income because I'm doing something different. I am putting all of my available income, all right? So $1,423, I'm putting it on my credit card. I'm making a payment to my credit card. Now, if you remember the other day, I talked about the jugs of water. If I am a runner, and I am, and I need 1 jug of water a month, let's just say, we know we need more, but let's just say I need 1 jug of water. But yet I'm giving my body 4 jugs of water, all right? So every month I'm giving my body 4 jugs of water. I'm giving my body 4 jugs of water every month. Do I still need the 1 jug? Well, no, right? I don't, because I have 4 that I'm giving it, right? I have 4 more here. So I don't need the 1 anymore. I'm giving it 4 more. So in other words, I don't have to hold this out anymore from my available income because I'm giving all of the rest of my income to this credit card. So that now becomes cash flow. So I've taken now and added $270 to my cash flow. So no longer does this student have $88 in cash flow, but they have, ready? 270 plus 88 equals, all right, so for those of you that are math challenged, right, and that's okay because many people are, so 358 becomes their cash flow, minus, though, the interest that's charged on the credit card, which is 24%. Now, we'll go over that when I do this and I run this example for you so you can see the inner workings of it, okay? So, what is the one small change you're going to make? What is that one change? The change is we are not going to be feeding the checking account anymore. Instead of feeding the checking account, we are going to be feeding our credit card. We are going to be putting our income on the credit card so that we get back that credit card payment, and that credit card payment works our debt down. And I'm going to show you that in a live example in just a few minutes here. So when you know that you are one small change away from being debt-free, and that small change is where you put your money, that's it. You're doing nothing else. You are not going out and getting another job. You are not selling everything and your kitchen sink and your kids, right? As somebody says, right? I laugh at that because it's kind of funny. You are not, scrambling to, spend time away from your kids to find that extra job or sell those extra things. We're not doing that. We are instead changing where we put our money and how we use that money, okay? So we're just making one small change, and that is the difference between being debt-free and not being debt-free. That is the difference right there. So I'm going to work some examples for you of how we do this, okay? And we're going to run this down and show how we're going to take care of our city. Now, we know that our total expenses here, which I didn't write down for you, but our total in debt expenses, okay? So if I were to let this city card run out, it would take 16 years at this payment to pay it off. 16 years. We don't have 16 years. We want to be debt-free like yesterday, right? We don't have 16 years to wait for this crap. We're not doing it because we're making this change to get you out faster, right? Just like this student is making this change to get herself out faster. We can take 4 years and we can let this SoFi run for 4 years, and we're going to pay $34.99 on $5,200 that we borrowed, okay? So that's what we can do. And the total debts there, let's see, what do they equal? I didn't add them up, so let's do that. All right, so what do they equal? So if I were to run this traditionally, all right, if I can talk and type this in, and I probably can't. All right, so that means I'm going to be spending $42,000 in interest. So $42,024, all right, in interest. In interest alone, you guys, $24,000 in interest. We are going to have that or better. And that's what I'm going to show you today, all right? So let me clear the board and I will get working on these examples so you can learn how to make one change and become debt-free. Okay, so I'm back with our student scenario here. This is a woman who learned about us actually through a friend. She is in a situation where, again, she only has $88 in cash flow, okay? And so she's struggling with some of her debts, and she had heard and watched through watching videos, heard that there's ways we can get back cash flow so that you can pay your debts down faster using no other tools, right? No other tools like we teach than what you already have. Again, if we can get you another tool down the road, we're going to try to get you another tool to help move things along faster. But in her situation, that's not something she can do right now. So we're going to use the tools that she has at her disposal, okay? So I'm going to run this for you, including the loan, and then we're going to talk about how we would run this if we just had one credit card that was strangling us, right? So we do come across people all the time who just have that one debt and they need to work it down without much, cash flow to their name. So that's another thing that we're going to show you too. Okay, so in this student scenario, again, our income is $3,248. Her expenses are $3,160, which leaves her with cash flow of $88, all right? Rent, she has $1,155. Her car is for $489 a month. Again, I told you she's over limit on that card, the card. She's over limit on the card. It's $13,000, but she has $13,196. Again, that vicious cycle of paying that minimum. You can barely pay it, right? And then you maybe you're paying less, and then you have your late fees hit or over the limit fees. You have all these things happening, okay? So she's over the limit on this, and this card is at is $270 a month. $13,196, 24%. It's a city card. It's a 16-year payback, you guys. This is what it would cost to term it out, $38,525, okay? So this is choking her. This is strangling her. It has a stranglehold on her. Remember, you make one change. Keep that in mind. We're making one change. We are not going to run things through our banking account anymore, our checking account. We're going to run things through our card, and we're going to make deposits to our card, thus lowering our average daily balance, right? Which then drops your interest rate, a feature that just lines of credit have and not loans. Okay, so this is why lines are so powerful, because we can use them as a tool. So stop thinking about credit cards like they're these horrible things, you guys. The same
tool or the same card that has you in debt is the tool you're going to use to get you out of debt. Trust me on this. It works. Okay. So again, to term this out, it's going to be $38,525 for one city card with a balance of $13,196. So again, she's got this SoFi loan out there for $5,200. $181 is the loan amount on, or the monthly payment on that. It's at 28%. Okay. And you're at 4 years on this. Now, I've had people say, but if they stop putting money on their loan, okay, through direct deposit, if they don't do it that way, then, what do we do? Because we have all this interest on it. So the interest that you're saving, right? So SoFi is one of those loans out there that if you do an auto debit from your account, all right, your checking account, that they'll give you 0.25% off. All right. So you guys, if you're going to pay that through your checking account, you can continue to do that, right? Unless you get a line of credit and you want to move it all into that line of credit, then the only thing they do is they, take that percentage away. Okay. So that percentage off, which if you're going to put it through a line of credit at that point, like a personal line of credit, doesn't matter because you're going to get through it so much faster anyway. So just wanted to mention that they do offer you, yes, they will offer you discounts to auto debit, and they'll drop your rate for doing that. Okay. So anyway, so this is a 28% interest rate. It takes 4 years to get this loan paid off for $3,499 on a $5,200 initial loan. Think about that, okay? So that's more than half, all right? Now, again, because we're going to be working with a credit card, this Citibank card as our debt destroyer, okay? So our debt destroyer is going to be the Citi card. That means we have available income and chargeable expenses that we're working with. Remember, when you're working with personal lines of credit or HELOCs, right? Those are going to, you're able to put all of your income in because you can charge everything out of them. That is a special feature they have. But when you're working with credit cards, it does many times break down into available income and chargeable expenses. And that's exactly what we have here. So, and I showed in my example earlier, right, where we have available income of $32.48, and then you have to subtract off your rent, you have to subtract off your car, you have to subtract off this, right, because that has to be running through that checking account to get that percentage off. And so that's running out of the checking account. But this, we don't have to hold out of our income anymore because we're going to be using this as our debt destroyer, right? That means that this payment will come back to help work down our debt. Okay, so that means we're starting off with $1,423 as our available income. Now, chargeable expenses, we have $3,160. We're subtracting off the rent, we're subtracting off the car, we're subtracting off the SoFi loan, and we're subtracting off the Citi because those are still non-chargeable expenses. Okay, so what's left over then as our chargeable expenses, once you do that, is $1,065. All right. So the first thing we're going to do is we are going to just continue paying on our SoFi loan, and we are going to run everything we can through the Citi card, right? So like I said, remember your gas, your groceries, your utilities, any of your fund money, that's all going to be, those are all chargeable expenses, right? So we're going to run all of that through this Citi card, okay? So we're going to run everything we have through it. We're going to put all of our income that we can onto that card. That is what helps us drop our interest, right? So remember, you're wanting to add those gentle, okay? So adding gentle interest charges, and we do that through dropping our balance every month, okay? So when we start out, we're starting out with $13,196, okay? We know she's over limit. We're starting out with $13,196. We're putting all of our available income onto the card. So we're subtracting the $1,423. Now remember, our payment is only this, like those jugs of water, right? So if I need that 1 gallon, but I'm putting 4 gallons on total, I don't need that one anymore because I have these extra, right? Same thing here. We have all this extra. So that means this $270 comes back to help us work down our debt. All right. So that means we start with the $13,196. We drop it by our available income. So now we're at $11,773. Okay. So that means that throughout the month, though, we have expenses that come out, right? Just like our living expenses, our utilities, our groceries, our gas, all that stuff is going to be coming out at different points during the month. Now, in other videos, I talk about trying to stave the larger purchases off towards the end of that statement. But in this case, we're just going to say, these are coming out throughout the month, right? So then we also have interest that we have to pay because that credit card has a 24% interest rate. So we have to pay that. So we know that our interest is $249. All right. So how do we calculate that? How do we do that? Many of you who've been with me a long time, right? And other gurus out there that teach velocity banking know how to do this. But here's what we do. All right. So let me show you how to get this interest, how you calculate it. You take your high balance, your $13,196, okay? And you add your low balance. You're going to add your low balance to that of $11,773, which is going to equal $24,969, okay? And then you're going to divide that by 2. So we divide it by 2. That equals $12,484. And then you're going to multiply now by 0.24 because we have to turn this into a decimal, or you could multiply by the percentage, up to you, however you want to do that. And then you're going to get 2,996, but that is for a year's worth of interest. We're not keeping it at that for a year, right? We're going to continuously drop our balance. So we have to divide it by 12 to get our 1 month interest, which is our $249. Okay. So we know how to calculate that now, right? You take your high balance, low balance, you divide it by 2, you multiply by our 0.24, right? And then you're going to divide that number by 12 to get the $249. All right, there's my recap for you. Okay, so this is month 1. So ending month 1, we're at $13,087. This is where your checks come in. And not, the physical checks that you pay with, but you're, checking yourself. Okay. So we've got 13,087. Is this lower or higher than what we started with? Well, it's lower than what we started with, right? So that's a good thing. We're going in the right direction. All right. So that much is good. So now we do it all again for the second month, right? We have our income that comes in and it's the 1423 and it drops us to 11,664, but our expenses come out and our interest comes out. And as you can see, our interest has already dropped for the next month. Okay. So now we end month 2 at 12,976. The good news is it's below, right? It's below the 13,087 and we're now below our limit, right? Because we were over the limit. And, this is when I'd be calling and begging back that over limit fee. You guys call and beg them back every single time. I don't care if you did it the month before, you always try. All right. So now we're looking better, right? So we're under our limit now, and we're continuing to work our balances down. And so again, the check here is obviously this is less than this, so we're going in the right direction. Now, we are just working with the card here, right? So we're putting all of our income on the card. Now, we're going to do this. We're going to run this until we can pull in that SoFi loan, okay? So that's what the goal is here. Remember, we're looking at it, figuring out how we can get these debts taken care of. And we are going to try to pull in the SoFi loan. Now, at 26 months, our balances, okay, so 26 months, this is step 1, right? 26 months, our balance of the Citi card is down to $9,534, all right? This is when I'm going to be trying to roll that balance of the SoFi loan onto my Citi card. Hopefully we'll be able to do that because our credit and things have gotten better in the meantime. So this is when we're going to try for that. Or you could try for a 0% card. It's really going to depend on you. It's going to depend on where your situation is, what your credit score is, how close you are to getting 0% offers. There's a couple things you can do here. But in this case, again, we're going to roll it to the Citi card. We're going to get our convenience checks. We're going to move it over, right? That's how we're going to do it. Okay. So we know that at this point, we have paid $5,646 in interest running it on that card. Okay. So we're running it down. We're running all of our expenses, all of our incomes going into it. And right now we've paid $5,646 at 26 months. All right. Remember, our payback is 16 years, $38,525. Right now we're at 26 months. We've paid $5,646. So step 2, beginning of step 2, we roll in that SoFi, right? We roll in the loan. And now we know that at 26 months, and again, you go to your calculators, right? Your amortization calculator, and you figure out where your balance is. If you're looking to do this on paper, right? If you're living it, you're going to know that in 26 months, you're going to see what your balance is on the SoFi loan, and you're going to know when you can pull it in, right? So here we know that it's going to be at 26 months, our balance is going to be $3,091, and we're going to have paid $2,603 in interest on SoFi at this point. But we rolled it out now onto the card. We will have a balance transfer fee, undoubtedly. Now I've heard that there are some cards out there that don't have a balance transfer fee, which is awesome. But if you do, I'm always going to shoot for the high, and I'm seeing 4% almost all the time now. So I did it on the 4%. So that means 124 has to be added into our calculations, right? So I'm taking the 9,534 plus the 3,091 plus the 124. So we start out with $12,749. And again, we begin our pay down, right? Now, this has changed, right? Our income has changed. And why has it changed? Because we no longer are worried. This 181 has come back to us, right? So it's come back. We don't have to hold it out anymore. So now our income that we're working with is $1,604, okay? And so we then continue to run this and drop our balances, right? We know that our expenses come out. We know that our interest is coming out. And end of the first month, we end up with $12,448. Is it lower or higher than what we started with? It is lower. We are going in the right direction, which is great, okay? So now we have both of these taken care of, right? They're consolidated now into one debt tool, one debt weapon. And we know that when we run this, it's going to take us 29 months, and we are going to spend $3,970 on that. So what does this look like all together then? Now remember, we've spent $56.46 here, and while that was running, we had this running. We've spent $26.03 here, okay? And we've spent $39.70 here. So what did we pay, and how long did it take? Remember, we started out with $88 as cash flow, okay? $88 was it. That's all we had to work with. So here what we have is it took us in time 55 months, all right, which is 4.5 years, as opposed to 16 years for this loan, okay? This was 4 years, but we've moved some things around, okay? So this was, it took us 16 years. It took us 4 years here. So in order for this card by itself, okay, not even looking at our total debts, which is $42.24, right? 38,000, okay? And here it's taken 4.5 years, $12,219 versus the $42,024. I'm choosing Velocity Banking all day long, all right? All day long, I'm choosing Velocity Banking. Now, we pulled in the SoFi loan, we consolidated, we got things down to $12,219. So why do we Velocity Bank? Because it saves you time and it saves you money. She shaved off, look, over what, 11, 12 years in time just by doing it this way. She didn't get an extra job, right? She didn't sell anything. She certainly didn't sell her kids or her car or, you know, her pool. She didn't sell anything. She lived the way she was living. She actually doesn't even have to cut back on anything if she doesn't want to. She may choose to, but she doesn't have to. And she will be okay, and she will get out of debt. One change, you guys, one change. Now, let's look at it. Let's say you just have one card out there, okay? Let's look at this as if she didn't have the SoFi loan, and this 181 we'll say is in her living expenses. If we have just the card out there, what does this look like? Okay, so I want to show you what the card looks like, you know, it is as the only debt you have. And there are people out there that just have a card and they don't have much cash flow. So what kind of situation would this be? Okay, so if we just had that credit card and we were working it down, okay, we know that at 1604 would be then our income, right? Because we don't have this in the picture. All right, so our 1604 is then over here. Okay, so 1604. And now we start with a 13,196. We subtract off our income, all right, again, available income. And then we have chargeable expenses. Again, we're not dealing with the 181. So if you subtract the 181 off, that means we have 12,000 or 1,246 as our expenses, our chargeable expenses. okay? And so then we have to, our interest comes in, right? So we take our high balance, we take our low balance, we add them together, we then divide by 2, we multiply by 0.24, we then take that number, divide it by 12. All right, so we're getting our interest. So month 1, we end up with $13,085, okay? That's the balance. Is this higher or lower? Well, this is lower, right? And again, we're running from here. We put our income in, the 1604 drops us to 11,481. We add our expenses back in. We add our interest, see how our interest is dropping. We end up with 12,972, which again, this is lower than this. So we're good. We're going in the right direction, doing our checks. So if you're out there and you have one card that is just killing you and you don't have much cash flow, what will this look like for you? It'll look like this, okay? We're not chipping away very quickly, but we are chipping away, and that payment is coming back to us, and it is helping us work down our balances, all right? So what would it look like at that point, okay, if this is what you had to deal with, using the same numbers here, okay? This would take 58 months. It would take 4.8 years. It would cost us $8,853 in interest. But remember, doing it the traditional way, banking traditionally, it was going to be $38,525. That is a significant savings when you look at it that way, isn't it? So again, Velocity Bank, why we do it? Saves you time, saves you money, and you can do this by making one change. You guys have credit cards. You're using credit cards anyway. You may as well use them as the debt weapon that they are, as that debt destroyer that they are. So I hope you guys have learned something today. Thank you for sticking with me. If you guys want to, if you want to be in the workshop, if you want to, take a crack at your own numbers, get our worksheets, email me, get the worksheets from me, and we will get you a link and add you to our workshop in July there. We're going to try to run one of these every month. We're going to see how they go for you, see if you guys like it. And again, it's a win-win, because at the end of the day, if you still think you want somebody to run a coaching plan, if you want us to run it for you, we just subtract the amount of that workshop right off of it, and you can then have us do a plan for you. But you won't need that, because you guys are going to figure this out. It is not difficult. If you want that guidance, somebody looking over your shoulder, we're happy to do it. Have an awesome day, you guys, and I will see you in the next video.